Now let's discuss about the current liability or non-current liability. How to classify the liability into current or non-current liability section. That is important because the investors, like the company, having the long-term liability rather than current liability. So we need to focus on the intent and the ability to refinance. If this liability is classified as long-term non-current liability, that means that company has intent and ability to refinance. Let's take an example of a long-term debt in current liability. The, the portion of a long-term debt that matures in the next year, even though this is a long-term debt, because the maturity is now less than the 1 year, and then it is classified in the current liability. If it is if a short-term debt in a non-current liability classification, that means that a current portion of a long-term debt to be refinanced with the intended and ability evidenced by an actual refinance before a balance sheet. So the point is again the intent and ability to refinance. Sometimes short-term debt or long-term debt can be classified as a non-current asset. For example, sinking a bond a fund to be retired by restricted asset accumulated for a specific purpose. Now let's take an example of this exercise. ABC trial balance included the following at December 31st, the fiscal year 1, and we have the balance sheet information in the current liability and the non-current liabilities of loan payable and a note payable, a bond payable. So how do we reclassify this current debt and non-current debt? First is subsequent event. Subsequent event means the event incurred after the balance sheet date, the December 31st year end, for example, the fiscal year end, and the issued date when the company issued the financial statement, usually around the February or in March. So subsequent event number 1, the ABC Corporation had $120,000 that is a loan payable due in the year 2 in short-term liability section of a balance sheet at the end of the current year. ABC issued $40,000 common stock subsequent to the end of the year, but before the financial statements were issued. The proceeds from stock issued were intended to be used to pay the loan payable. So this is exactly that the case of the case that the company has the ability to pay this long-term, this short-term loan payable. So out of $120,000, the reason why company issued common stock after the balance sheet date, but before the financial statement were issued, is that the company has the company is going to going to pay this proceed to the loan payable. So the company has ability. So out of $120,000 short-term loan payable, $40,000 should be reclassified in the non-current liability. So loan payable $40,000. Then the rest amount doesn't have the ability to pay. So the loan payable should be out of $120,000 minus the $40,000. So again, or just $120,000 minus the $40,000. Okay. Then the note payable. Note payable is in the current liability, but when the subsequent event number 2 incurs, it can be different. So ABC signed a binding agreement with a bank for the refinancing of an existing $400,000 note payable scheduled to mature in February year 2. The terms of the refinancing include extending the maturity date of the note by 3 years. That now on January 15th of year 2, the note was refinanced. So that's good. It should be reclassified in the non-current liability. But the point is that on January 2nd of year 2, before refinance, ABC had excess cash and paid $150,000 of a note payable. Now, even though the company has ability or intent to refinance, it now comes out that the company decided to pay and they actually paid this note payable. So the intent of this note payable is to pay out, so not refinancing. So by this amount, the company now should record in the current liability. That's correct. So note payable. I'm going to just use note payable. How much? Right, $150,000. That rest amount is going to be refinanced. So note payable one more time. But that amount is now out of 400,000 minus 150. So again, this note payable is going to be paid out. So that's why it is in the current liability. That's the intent of the company. But the rest amount of $250,000 is going to be refinanced. So it should be reclassified in the non-current liability. And finally, the subsequent event number 3, ABC had $800,000 bond payable due to March 1st, year 3, and discount on the bond payable of $30,000. That means the net bond payable book value is $770,000. So we got this, the net book value. On February 1st, year 2, ABC was informed by its financial advisor that the lender is not expected to be financially capable of honoring the agreement. The bond indenture does not expire within 1 year as long as no violation of any provision in the financing agreement exists. But there's some issue, not expected to be financially capable of honoring the agreement because ABC did not comply with the provisions of bond agreement. So it's no longer the non-current liability because the company doesn't have ability to pay out this $770,000 by violating this provision. So it should be recorded on the current liability of the whole amount, $770,000. And then that is also this procedure, this subsequent event, and some specific information related to the reclassification of all the liability should be disclosed in the notes section on the 10K or 10Q. So for example, note information, note payable on current liability on January 2nd of year 2 repaid. This year 2 repaid note payable $150,000. There you go. It should be disclosed. That's why it is recorded on the current liability. Then the bond payable. What about the bond payable? Another note payable. The remaining note payable on the non-current liability should be disclosed on January 15th. January 15th of year 2. Refinanced with extending by 3 years, so that investors can recognize this rest amount of this note payable $250,000 is in the non-current liability. Then what about the loan payable? Loan payable on non-current liability section, the cash proceed of $40,000 from the issuance of common stock will be used to pay the loan payable. And then the bond payable information. Why this bond payable is in the current liability? It should be disclosed as well. The violation to comply with provisions of a bond agreement, for example. All this, the reclassification of the liability should be disclosed on the notes. With this information. Okay, see you in the next video clip. Bye bye.